Investors are currently paying a 52% premium for a stock that is mathematically overvalued by nearly $50 per share. But here is the terrifying part. While revenue is inching up, actual profit is collapsing. Is this a safe haven or a hollow fortress about to crumble? According to the classic Benjamin Graham valuation method, the intrinsic value of this asset sits at just $103, yet the market is asking you to pay $158. That is a massive disconnect. Today we are performing a rapid health check on Procter Gamble to understand why. You see, when we look at a giant like P&G, we get blinded by the brand names in our pantry. The Tide, the Gillette, the Pampers. We assume safety. But as financial detectives, we have to look past the logo and look at the physiology of the business. And right now, the numbers are telling a story of a company that is growing in size but shrinking in strength. We have to start with that valuation gap I just mentioned. This is the valuation trap. At $158, the market is pricing P&G as if it were a high-growth tech stock. But when we run the numbers through a discounted cash flow model, which is essentially calculating what all the future cash the company will ever make is worth today, the stock still looks nearly 20% overvalued. Now, why does this matter? Because of the noise. You hear conflicting opinions everywhere. Buy defensive stocks, they say. It's a safe bond proxy, they tell you. This flood of information creates analysis paralysis. It makes you feel anxious and unsure of who to trust. But when you strip away the noise and look at a hard metric, like the Graham number, the anxiety disappears. You have clarity. And the clarity here is telling us that you are paying a luxury price for a utility-like performance. This is the core principle of value investing. Price is what you pay, but value is what you get. And right now you are paying a premium for a reputation, not for the reality of the cash flow. But to fully grasp why the valuation is so stretched, we need to look at the engine of the company. This leads us to the hollow growth warning. On the surface, P&G reported a revenue increase of 1.5%, bringing in over $22 billion. At first glance, this looks fine. It shows they can still move product. But here is the twist that changes everything. While revenue went up, net income plummeted by 6.8%. Think about that for a second. They sold more, but they kept significantly less. This is what we call profitless growth. It suggests that the cost of doing business, raw materials, labor, logistics, is rising faster than their ability to raise prices. The company is running faster just to stay in the same place. This is where many aspiring investors get trapped. They see revenue growth in a headline and hit the buy button. But true fundamental analysis, the kind we do with the MV Pro score, looks at the relationship between the top line and the bottom line. It eliminates confusion and replaces it with focus. If you are buying a company that cannot translate sales into profit, you aren't buying a business. You're buying a charity for suppliers. So if the profits are leaking out of the bucket, where is the money going? This leads us to the most alarming metric in this entire report, the warehouse red flag. If you only remember one number from today, make it this one, 11.4%. That is how much P&G's inventory ballooned in the last quarter. Now ask yourself, does it make sense for inventory to grow by over 11% when sales only grew by 1.5%? Absolutely not. This is a massive divergence. At first glance, an optimist might say, maybe they are stocking up for a demand surge. But look at the retail sales data. It's hovering around 3%. The consumer is tapped out. The deeper interpretation here is that P&G has a blockage in its arteries. They are producing goods that are getting stuck in the warehouse. And you need to remember that inventory is not just cardboard boxes. It is cash. It is capital sitting on a pallet, risking obsolescence. If this trend continues, P&G will be forced to discount those products to clear the backlog. And what happens when you discount? Your margins get crushed even further. This is a classic ticking time bomb that often goes unnoticed until it's too late. Most generic stock market analysis won't flag this for you. They just show you the price to earnings ratio and move on. But by using specific filters, you can spot these anomalies instantly. It's about moving from feeling overwhelmed by data to feeling empowered by insight. The lesson here is vital. Watch the inventory. If it grows faster than sales, the company is failing to manage its supply chain. Now, speaking of crush margins, let's look at the battlefield of inflation. We need to talk about margin compression. P&G is famous for its moat. The theory is that if costs go up, P&G can just raise prices, and we will pay it because we love the brand. But the data says that moat is drying up. Net margins have slipped from 20.8% down to 19.1%. Why is this shocking? Because P&G has been aggressively raising prices for 2 years. This decline proves that they have hit a ceiling. They can no longer pass costs onto the consumer without destroying demand. Inflation is winning the war. This creates a terrifying sensitivity for the company. We ran a scenario analysis, basically a stress test for the future. In a pessimistic scenario, if their free cash flow margin drops to 12% due to these rising costs, it would wipe out over $4.6 billion in cash generation compared to their base case. That is $4 billion less for dividends, less for buybacks, and less for paying down debt. And that brings us to the next layer of risk, which is perhaps the most dangerous because it is hidden in plain sight: the leverage ceiling. P&G is often viewed as a safe stock, almost like a savings account. But look at the long-term debt to EBITDA ratio. EBITDA is just a fancy way of saying core earnings from operations. That ratio has spiked from roughly 348% to 397%. Let's put that in perspective. A ratio of 400% is generally considered the red line, the danger zone where debt becomes a burden rather than a tool. P&G is knocking on the door of that danger zone. With interest rates holding steady, servicing this debt is becoming more expensive. At first glance, you might think it's P&G. They are good for it. But the complication is that when you combine rising debt leverage with falling profits, you kill the magic of compounding. Instead of using cash to grow, they have to use cash to service the past. The golden rule to remember for your investing strategy is this: leverage magnifies outcomes. It makes the good times great, but it makes the bad times lethal. And right now, P&G is leveraging up right as their efficiency is winding down. This situation leads us directly to the next, even bigger question. If the fundamentals are deteriorating, profits down, inventory up, debt up, is the market starting to notice? And this is where the story gets really interesting. We are seeing a sentiment shift. Look at the price to earnings ratio, or PE. This simply measures how much investors are willing to pay for $1 of the company's earnings. A year ago, investors were willing to pay 27 times earnings. Today, that number has compressed down to 22.5. Now, a novice investor looks at a falling PE and thinks, great, the stock is getting cheaper, it's a bargain. But you have to look deeper. This isn't a bargain, it's a derating. The market is actively deciding that P&G is worth less today than it was yesterday. The premium for safety is evaporating because the safety itself is in question. This is the health check moment. When the PE ratio falls despite the narrative that this is a forever stock, it signals that institutional confidence is waning. The big money is realizing that growth is stalling. This brings us to the final piece of the puzzle: asset bloat. The asset turnover ratio is sitting at 0.67. That means for every dollar of assets P&G owns, factories, machines, intellectual property, it generates less than 70 cents of revenue. It is heavy. It is inefficient. When you have a company that is heavy, carrying too much inventory and losing pricing power, you have a problem that cannot be fixed with a simple marketing campaign. So let's circle back to our core thesis. Is P&G a safe haven? The data suggests it is a hollow fortress. We have a stock trading at $158, while its physiological reality, its Graham value, is closer to 103. We have the hollow growth paradox of rising revenue but falling income. We have an 11% surge in inventory clogging the arteries of the business, and we have debt levels creeping toward a critical ceiling. This doesn't mean P&G is going to go bankrupt tomorrow. It's a massive, durable company. But as an investment right now at this price, the risk-to-reward ratio is skewed heavily against you. The greatest strength of the company, its brand, is currently being undermined by its Achilles heel: operational inefficiency and an inability to manage costs in a sticky inflation environment. But I want to hear your take. Do you think P&G's brand power is strong enough to justify the premium price, or is the inventory glut a warning sign you can't ignore? Let me know in the comments. So hit subscribe so you won't miss what's next, and jump straight to the next video, because that could be the very insight you need to get ahead.